Bet you didn't think that the longshoremen, those lazy bastards over here on the East Coast that are walking off the job, striking after demanding a 77% wage increase, didn't need any help in shutting down the entirety of the US economy. Well, turns out it's not going to be that easy. What's up, apes? Welcome back to another edition of the 𝗙𝗟𝗡𝗚's Daily Podcast of the Day. Thank you all for joining us here once again on this beautiful Tuesday, October 1st, 2024. We appreciate you joining us here. It is currently 6 p.m. Eastern Standard Time, and we got a lot to talk about here today, so let's just go ahead and dive right in. Bet you didn't think that the longshoremen, those lazy bastards over here on the East Coast that are walking off the job, striking after demanding a 77% wage increase, didn't need any help in shutting down the entirety of the US economy. Well, it turns out it's not going to be that easy, but they are already getting some assistance from the manufacturing sector. So, it seems like others are in on this evil plot to slow down the US economy as well, and we'll be breaking that down for you in just a quick second. It also turns out NVIDIA has some brand new competition. Now, it's not necessarily new competition for their chips or their actual products that the business sells, but competition for investor attention. So, we'll break down exactly what's going on there. That's our final story of the day, so make sure to stick around to the end of the video for all of those updates. We'll also be talking about why your odds of dying on a foreign battlefield on behalf of the investors of Lockheed Martin increased dramatically here today. So it's a great day for all of us here. Let's go ahead and talk about the WSO Alpha portfolio. This is our proprietary long-only equity portfolio that we manage over here at Wall Street Oasis. Rough day for us. I certainly can't lie. You know, I would never lie to you guys. We were down about 93 basis points for this session here today. We did get a huge uptick. Well, huge uptick. I guess it's relative to the overall portfolio, but we got a 1.25% return from Zillow on the day, about 125 basis points. The housing market was really kind of carrying the team because Builders First Source was another one of our, basically one of our four stocks that actually moved higher on the session, up 51 basis points for the day. There's a whole lot of volatility going on in markets right now because some of the market's least favorite thing ever just increased, and that is, of course, uncertainty. So when uncertainty increases, like the market just kind of wants to know what is going to happen. Like if the results are going to be bad, great, we can plan around it. If they're going to be good, that's fantastic, stocks will go up. But when the market has no idea what's going to happen, we as humans, what do? Assume the worst. So when there's an increase in uncertainty, that really kind of fucks over Mr. Market. So we were down 93 basis points on the session here today, exactly in line with the S&P 500. I'm completely humiliated by that. Beating the S&P 500, I'm pretty sure my dog can do it. So, you know, it's a little bit rough to see that we tied up with them both down 93 basis points for the session. Small cap stocks had a much rougher day. Again, increased uncertainty. Small caps have a higher degree of uncertainty already baked into them than large cap stocks. That's why they're fucking small caps. Russell 2000 was up 1.36%, lost about 136 basis points on the session there, so rough day for small caps. NASDAQ down 153 basis points, did even worse because names like Apple, NVIDIA, Microsoft, Broadcom, basically any big tech stock completely sold off for the day. Not that anybody cares, but the Dow was down 41 basis points. Fuck the Dow. Who cares about that at all? Getting into some of the banana bits for the session here today. I'm probably going to add more in the written piece tomorrow because it's still a little bit early for some of the evening news to be coming out here today. But the biggest story of the day by far was escalations in the Middle East. The threat of looming war with Iran was described as, quote, imminent by U.S. officials. This isn't war between the United States and Iran. It is Iran and Israel that they're talking about right now. Specifically, Israel is potentially planning a ground invasion into Lebanon to fight Iranian-backed Hezbollah forces that are in that country. And Iran also is kind of bombarding Israel already with a bunch of missiles going into the country, but Israel has kind of an Iron Dome defense system, so it's not like they're getting constantly raided like London in World War II or Dresden. We don't have to talk about Dresden. But still, the tensions and escalations in the Middle East are getting to the point where it certainly seems like there's going to be a full-scale war relatively soon, and markets definitely don't like that. Oil prices absolutely love it, and we'll tell you exactly why in a few minutes. Meanwhile, here in the United States, our own tragedy, damages from Hurricane Helene, I believe it's pronounced Helene, are estimated to total $35 billion. This is what the early estimates are saying. Pretty sure my former state of North Carolina, at least the western portion of it, is still underwater. Shout out to anybody that's out there in Georgia, North Carolina, Tennessee, any of those other regions that might be particularly adversely affected. Hope you guys are doing all right if you're in those areas. Longshoremen, they're certainly not helping out because amid this devastation that's going on the East Coast, these fucking lazy bastards decided to walk off the job yesterday. This strike, if it goes on for more than a week, could re-trigger inflation. It could fuck over 𝗟𝗡𝗆's whole shit. So we're really hoping that this gets resolved pretty soon, but arguing for a 77% wage increase and the banning of automation of cranes, trucks, and gates like these longshoremen are going for, pretty low likelihood that that actually occurs. So send your applications if you want to go be a longshoreman. If you really want to contribute to the economy, if you want to create shareholder value, no better way than to go stand on a port and unload some fucking cargo ships for the rest of us. So go get to it. Meanwhile, Nike just reported some earnings. They beat on the bottom line, but they missed on the top line. There's a lot of, we've talked about Nike a good bit here, but amid the CEO shakeup that's going on right now, the company is very much looking to become cool again. So they're making some interesting investments. Definitely worth checking out their press release that comes with the earnings report. You don't have to read all the boring ass footnotes or anything, but just check out some of the guidance there because it's some pretty interesting insights. Meanwhile, Ford, another great American company, is giving out free home chargers with its sales of electric vehicles. Now, this is a blatant attempt to catch up with the likes of Tesla, because no other EV company or EV car really seems to have, caught much of a foothold in the market. One of my friend's dads actually does drive a Lucid now, though. He was a big Tesla guy for a while. He just leases them every couple of years, and he's on the Lucid. Pretty sure he likes it, but I haven't talked to him since he originally got it. So it'll be interesting to see what he has to say there. But I don't think anybody on Earth has bought the Ford electric vehicle. So we'll see if that actually does anything to increasing sales in that department. Okay. Moving on to our big macro story of the day. We were talking about extreme mediocrity. If I was writing a book about my life, that might be the title of it right there, Extreme Mediocrity. But I'm using it for you guys here today. That's like taking a name that I had planned for my child and giving it to my dog or something like that. So it's a pretty big sacrifice for you guys going on here. Speaking of me, by the way, the U.S. manufacturing sector kind of looks exactly like I did in high school right now. Extremely ugly on its face. Trust me on that one. If you saw picture, I might share my high school basketball photo so that I can show you guys exactly what I'm referring to here in this video. We'll see if I can get it over to our editor there. But ugly on its face, underachieving across nearly every single metric, but still having fun, optimistic, and certainly hoping for the best. Now, my parents, they can go ahead all day and brag about my 2.7 GPA in college or the dozens of podcast listeners that we've amassed over here, but still, there's hope for the U.S. manufacturing sector, while there might not be for your boy on the other hand. September's Purchasing Manager Index for the U.S. manufacturing sector just dropped earlier here today. It dropped, meaning that it got released, and actually it didn't drop. It's in contraction territory, but stayed at the exact same level that it was at in August, 47.2%. Now, the way that the ISM Purchasing Managers Index works is any reading above 50 is expansionary for the manufacturing sector. Any reading below 50 is contractionary for the manufacturing sector. Any reading below 42.5% signals that the entire economy is either in or heading for a recession. So we're at 47.2%. That was the 6th month in a row and the 22nd of the past 23 months that the U.S. economy has been in a recession. Now, the good news is, or not recession, contraction in the manufacturing sector. The good news, though, is that we've kind of maintained a certain level. Like, we've been pretty range-bound between, 46.4 and, slightly over 50.1 or so back a couple months ago, back in May or April of this year when we actually entered expansion territory for the first time in a while. So it's pretty range-bound in this context, and it kind of just underscores the overall uncertainty that's going on with the U.S. economy. So, once again, we saw absolutely no change in the month of September, at least on a monthly basis. The excruciatingly mid-performance that we're seeing at that 47.2 rate, like I said, it does underscore the uncertainty that's plaguing the U.S. economy. Purchasing managers, they don't want to go balls deep and buy a whole bunch of new shit when there's, there's a high degree of opacity on the policy path for interest rates and other monetary policy going forward. Supply chains could get snarled, will get snarled if this fucking longshoremen strike goes on for any longer, and just as we were starting to kind of replenish supply chains from the multi-year impacts that the pandemic had. Plus, aggregate demand has been wavy, to say the absolute least. If we look at retail sales, if we look at business spending as well, it's been, kind of like these purchasing managers, consumers and businesses more generally, there's so much opacity on the interest rate scenario, on supply chains, on pretty much everything economy-wide that it makes it difficult to plan for the future, right? At least a little bit more difficult than it typically is. Now, Fed Chair Jay Powell, I was going to say he tried his best to clear things up on Monday, but he clearly didn't. He used his native tongue of Fed speak, did his damnedest to be as absolutely vague as possible and say nothing at all about the policy path forward for the Federal Reserve. So, there's more rates to be coming, but there's no plan whatsoever for when those occur. Meanwhile, like we said, the longshoremen, they're on strike, so that's kind of fucking over the supply chain. And if we dig deeper into this Purchasing Managers Index report in itself, we can start to uncover some of these concerns around the aggregate demand side of things. So, if we look at some of these subcomponents, there are a total of 1, 2, 3, 4, 8 subcomponents in the Purchasing Managers Index here. We saw an increase across 4 of these and a decrease across 4 of them. Now, the ones we did see an increase on include new orders by 1.5%. We saw production increase by 5%. Backlog of new orders increased by 0.5%, and supplier deliveries increased by 1.7%. Apologies for making you suffer through listening to that, but it's going to be important in just a quick second, because at the same time, we saw prices decrease 5.7%, the employment index decreased 2.1%, inventories were down 6.4%, and new orders were down 3.3%. Now, so the 5.7 decline in prices, that might be the first one that catches your attention given how hot inflation still is in the minds of investors and consumers around the country. This was the first decrease that we've seen this year. It fell to 48.3%, meaning that prices are officially in contractionary territory. Now, that might sound good, but that means aggregate demand could be a little bit shaky. When demand is high and supply remains the same, that's going to push prices higher. So if we assume that supply remains the same, which we don't really know yet because that data takes a little bit more time to come out, if we assume that supply remains the same, if prices are dropping, that means that aggregate demand must have been dropping. But at the same time, if we go back to some of those other indexes that I mentioned, the supplier deliveries index was up 1.7%. So that means that despite the fact that prices fell, deliveries were still increasing quite a bit. New orders were up 1.5% and production was up 5%. But the biggest thing here is that inventories fell 6.4%. So what we could be seeing is purchasing managers playing a little bit of catch up here. So we've known over the past couple of years, and especially in recent months, if we look at some of these automakers, especially if you look at GM or anything else like that, inventory buildup has been a bit of a problem in the U.S. economy. Companies have been kind of a little bit overly optimistic on what they're going to be selling in their projection period, so they've been building up inventories a lot. We've seen a lot of write-downs that are hurting earnings estimates on these on the calls that we saw in the second quarter for this year. So this has been a big problem, that inventory buildup. The fact that the inventory index fell 6.4% may indicate that these companies are actually starting to move that inventory, and that makes sense. It's given that supplier deliveries increased, production and new orders increased as well, so those were a little bit more moderate. So that could be signaling that demand is just starting to kind of get re-triggered now that we've worked through a lot of these inventory problems that we've been having. Now, with that said, there are a couple of things that go against that thesis. For example, the decline of 2.1% in employment. But at the same time, it's, a question of magnitude at this point. And it's not just the percentage, because we have to think about its weightings in the sector overall and then related to the totality of GDP. So that's something that we don't have the capital, nor the time, nor the word count for to do over here at the Daily Peel Global headquarters. But what we can do is tell you that the decline in manufacturing employment, at least, probably isn't as much of an issue as you might think it is. Now, if we look at total manufacturing as a share of employment in the United States, we can see that manufacturing employment is at an all-time low. Now, the latest data that I was able to see has manufacturing making up about 8.3% of total employment in the United States. That is, once again, the all-time low. If we compare the United States to other countries, we're also tied for the lowest with those lazy fucks over in the United Kingdom, because nobody wants to do any work in these countries anymore. So 8.3% of the economy is reliant, or 8.3% of employment is based on the manufacturing sector. The fact that it declined probably won't have a material impact on the jobs report for September, but we're going to find that out on Friday. Overall, however, the manufacturing sector, the reason for concern here is that the manufacturing sector does tend to be a leading indicator. If anything, it kind of points in the direction of where the overall U.S. economy is going to be going. So if this slowdown, if it's something that persists and isn't necessarily just plagued by a high degree of uncertainty right now, then we should be a little bit more concerned. But if your view is that, people are just uncertain and kind of waiting until a little bit more clarity emerges, then you shouldn't be too concerned. We are probably going to be fine. That about does it for a big story of the day. Let's go ahead and move on into some of these stock movers. What's ripe? Our first stock of the day, it was tough to find anything that was ripe for, a real actual reason here today, to be honest with you. It was one of those days where, this is a bit of a challenge, but Arcos Dorados Holdings had the absolute hookup. I'd be surprised if you've heard of this company before, ticker symbol ARCO. And this company, there's no better way to describe it than the world's biggest meat rider. And I mean that both figuratively and literally. Now, Arcos is a meat rider of, if I was going to meat ride any company, it would be the same thing. And that is, of course, McDonald's. Now, Arcos Dorados, they are the master franchisor for McDonald's in most of Latin America, especially across the Caribbean and South America in particular. So what did this company do? Well, yesterday they've re-upped their master franchise agreement with McDonald's for the next 20 years. So that means that this company, this franchisor, gets to continue to dominate those regions for the next 20 years at least. Now, the best part of this deal is that the royalty fee that has to be paid back to McDonald's corporate got locked in for the next decade at 6%. Now, it's currently at 6%, so it's not going to increase for at least another 10 years. Then it goes up to 6.25%. So once again, 6%, it might not be great. Maybe you want it lower than that. But what does that bring us? Certainty. And that is the market's absolute favorite thing right there. So it gives them something to plan around. So once again, it shares up over 14% on the session here today. Secondly, we have war stocks absolutely ripping through the moon. I couldn't decide if I wanted to do energy stocks or defense stocks. So I just kind of amalgamated them together into war stocks here. And specifically, we are looking at Lockheed Martin, we're looking at Occidental Petroleum, we're looking at ExxonMobil, and finally, we are looking at L3Harris Technologies. These are all, so L3 and Lockheed, those are pure defense stocks. Then we have Oxy and Exxon, which I'm sure you've heard of. Those are oil stocks right there. And respectively, they were up 3.64, 3.05, 3.33, and 2.31% on the session. Now, there's a lot of bullish activity while the rest of the market is selling off for the exact same reason that is triggering the broader market sell-off. So, like we said a little bit earlier, like we kind of alluded to, U.S. officials described the threat of a missile strike from Iran on Israel as imminent earlier here today. So, what does that mean? Well, it increases the odds of you going and dying on a battlefield over there on behalf of the shareholders of Lockheed Martin and L3Harris. I'm sure they would appreciate your shareholder value creation. But on the energy side of things, this is going to disrupt oil supply from the Middle East, which is where most of the world gets most of their oil. This is going to disrupt that supply. That means that supply is going to get reduced, if anything. And if we assume that aggregate demand remains roughly the same, which it won't because the Northern Hemisphere is going into winter, which means oil demand is going to increase, then we can expect to see some rising prices in oil. And obviously energy companies that sell oil tend to like higher prices. So overall, great day if your business is about destroying human lives or the environment. So very solid to see that kind of performance for them here today. Meanwhile, moving on into our stinky rotten movers of the day. We have Coinbase shares. Ever heard of it? Coinbase down 7.39% on the day. I always thought that inflation was supposed to be good for crypto. I thought rising geopolitical tensions would threaten fiat currencies and be great for crypto again, but absolutely not. Bitcoin found a way to still sell off on the day, and that triggered into a loss for Coinbase. Once again, down about 7.4% on the day here. Really, that's all it was. It was just kind of this increase in uncertainty as well. So Coinbase is a pretty volatile stock. I know it's hard to believe that a stock linked to crypto sees excess volatility, but it absolutely does, at least if we're speaking on Coinbase specifically. And what we're seeing with this company is that, it's just kind of a higher beta stock. So the fact that the rest of the market was selling off and Bitcoin was down on the day there too, kind of hit them with a bit of a double whammy and sent them down 7.4%. Moving on down into our next final mover of the day, we have CVS Health. This company is down 2.05% on the session here today because they had the audacity to think about ways to improve the business. Board members at CVS got together over the past couple of days and they are deciding on a brand new strategic path forward for the company. The idea was to do a strategic review of the business. Now, specifically, the company is facing a lot of problems in its insurance segment, in its pharmacy, and with retail traffic. So it's kind of trying to think of ways where it can improve all of these metrics, and at least according to reports that are circulating today, the number one kind of possibility that might occur is a separation of the company's insurance business. They could spin off Aetna into a different corporation entirely. So we'll see if that actually comes to fruition, if it makes any kind of improvement. There's this idea in capital markets that, looking at Amazon, for example, Amazon is kind of the classic example that people point to. But if you have a conglomerate that's operating in multiple different sectors, typically the multiple on earnings that you're going to receive is going to be the lowest common denominator. For a company like Amazon, that's going to be the retail side rather than the AWS, cloud, artificial intelligence side of things. So they kind of pulled themselves, they reduce the value of the company overall because the retail side is so low margin and tends to get a very low multiple. So this is just one thing that kind of threatens companies like CVS that could have a higher multiple if they focus exclusively on, if they ditch the insurance side and they just focus on, pharmacy, retail. They could even still do some care. I really don't know, but it's interesting to see because I actually went to CVS recently for some healthcare. I got a tetanus shot. Please don't ask me why I was there getting a tetanus shot, but they didn't charge me anything for it. And I was walking out of there like, is my insurance paying for this? Because I even asked, I was like, where do I pay? And she was like, you don't pay. And I was like, I guess I'm fucking retarded then. But either way, I get it might be something that insurance does on the back end, but I'm 24 years old. I got another year and a half or so before I have to fucking figure out my own insurance bullshit. So I'll let my parents deal with that for the time being. Okay. Moving on into our final story of the day, our thought banana, we have NVIDIA shaking in its shoes. Yes, you heard me correctly. Rumors are swirling that NVIDIA hasn't gotten any sleep in the past couple of weeks. There's a new competitor that's coming to public markets. Bloomberg, the Wall Street Journal, all of those guys, they were reporting on Monday that NVIDIA had actually started to pee its pants repeatedly after the filing of this S1. So we got an S1 from a company called Cerebras. Cerebras, this is an artificial intelligence chip maker, and they are officially going public under the ticker symbol CBRS. So it's going to be interesting to see exactly what happens here. We know that NVIDIA is scared because, more than 2/3 of NVIDIA's employees are millionaires, and I think 1/3 of them have a net worth of more than $20 million at this point. So they must be absolutely terrified. I'm sure they're not completely fine and diversifying their portfolios, which if you're an NVIDIA employee watching this, please diversify your portfolio. But nonetheless, founded in 2015, Cerebras describes itself as, quote, an artificial intelligence company. Now, that's a ballsy move, so let's see what they have to back that up. Well, their mission is to accelerate artificial intelligence by making it faster, easier to use, more energy efficient, and making AI accessible around the world. They want to put AI in your pocket. Now, is that going to lead to the destruction of humanity? Maybe, but there's only one way to find out, and that is to do it. So let's see if that's actually the goal here. If we look at some of the financials that were released in the S1, which is, an S1 is just a registration statement. It tells the SEC, hey, we're going public. This is all of our business. Usually you got to file it back and forth a couple of times, but still, the S1 has officially been finalized for Cerebras. So the company reported back in 2022, the firm made $24 million in revenue, and they lost a whopping $177 million on the bottom line. Now, 2023, things improved a little bit. They made $78 million on the top line, and they lost only a measly little $127 million on the bottom line. So, nice reduction in its losses at that point. Halfway through 2024 so far, this is just the first 6 months of this year. Revenue is already up about 73%. We're seeing revenue of $136 million so far this year and a loss of $66 million. So in preparation of going public, the company is clearly cleaning up their act. We're seeing NVIDIA-like growth on the top line, 220% between 22 and 23, and then growing another 73% from fiscal year 2023 to just the first half of 2024 alone. Losses are also narrowing, declining 28% in the last two actual full fiscal years, then down even more so into the first half of 2024. But if that doubles, it'll be, like if we assume it doubles from here, it's going to be slightly larger. It'll come in at about 132 million, so a little bit larger than 2023, but on a much higher revenue amount. So we'll see how the market actually values that. Now, what is it that Cerebras actually does? Well, they focus on hyper-technical artificial intelligence use cases. NVIDIA fucks around with, they do the hyper-technical stuff like the AI model training and inference, but they're also dicking around over here in the gaming sector and putting chips in cars and shit for some fucking reason. Whereas Cerebras is only focused on the most kind of extreme niche artificial intelligence applications. Now, the way that they do this is they sell a big, giant chip. I'm not talking about the chip on your shoulder and why you're going into the investment banking sector, but I am talking about a huge microchip. If I was holding it, it would look, I'm trying to think, like I have this thing that's near my desk. Imagine probably 2 or 3 of these, to be honest with you. And this is, I'm about 6'4" for reference, by the way. So take that into consideration. This thing is giant. It's an entire wafer-sized, I don't know how big a wafer is either, and I'm sure you don't, but that's what they describe it as. It's an entire wafer-sized chip in itself. Most of the time, what companies like NVIDIA will do, AMD, Intel, Broadcom, all these other competitors, what they'll do is they'll take one of those wafers and fucking plaster the thing with a bunch of different chips that kind of work parallel with each other. What Cerebras does is it puts the entire chip on that wafer, and it works a hell of a lot quicker, uses way less energy, so it's a lot more efficient, and overall is just a much better technical solution for the most kind of advanced artificial intelligence problems, specifically in artificial intelligence model training and in inference. And that is exactly where Cerebras is going after. That's kind of where they're targeting this market. The firm is specifically targeting a $7 to $8 billion valuation. A bunch of large VCs are involved in this investment. Even OpenAI CEO Sam Altman has investment in the space. Now, the big problem for Cerebras, at least the biggest one that we saw in the S1, is that 83% of revenue comes from just one customer based in the UAE. TSMC is also the company's sole supplier, so TSMC based in Taiwan, this company based in the UAE, both of those regions of the world aren't exactly known for their peace. So this could be a bit of a threat going forward for the company, but for now, investors are loving it. Again, ticker symbol CBRS, and be on the lookout for it, because it should be coming into markets within the next week or so. All right, let's finish up with our quote of the day from none other than NVIDIA CEO Jensen Huang. He said, "Embrace the unknown and embrace change. That's where true breakthroughs happen." Thank you, Jensen. And it sounds like NVIDIA is definitely going to have to do so. Whether that's, keeping investor attention from the new high-flying AI stock that's about to come onto the market, keeping customers' attention from this giant wafer that's a hell of a lot faster and works way better for their products, or if it's actually just focused on keeping their employees now that more than a third of them are worth $20 million or more. This is where those true breakthroughs are going to happen. We can't wait to see what NVIDIA comes up with next. All right, that about does it for us here today, Aves. Thank you all for joining us here once again. Always love coming on and chatting with you guys. Also saw a great email from another one of our listeners who was out there buying gold yesterday. So shout out to him. Definitely hope that trade is going to be working out in the short, intermediate, long term, whatever you're looking at there. But otherwise, as always, guys, reach out, keep me updated with what's going on in your world. And if it's funny enough, I might even talk about it here. So happy investing, happy trading, and we'll see you guys tomorrow. Bye now.